now we're back in chapter 11, and we began talking about losses. We went through some examples there with Martha Stewart, and that's important. Those are questions that you guys will be tested on and that you will have in your assignments, exams. So make sure that you understand what we went through there on that last class. Now we're going to continue today, starting here at slide 18, and we're talking about business investment losses. Now, this is something that an individual can claim, and this is a different type of loss. So let's kind of clarify. We've talked about net capital losses, and we talked about non-capital losses. So our net capital losses were the net of our gains, our capital gains, and our capital losses. So we defined back in chapter 8 what capital gains were. We also had some other losses that we had talked about, you know, your personal use property, your listed personal property. So that's 4 different types of losses, all with their own special rules. You could also have a current year loss in your employment or your business. These losses could all factor in and be kind of compiled with your other losses. We did our little formula, E minus F, and those different losses were fitting into there. Now we're actually adding another one. So this is called a business investment loss. And this does not mean you operated a business where expenses exceeded revenues. That would be just a part of your regular annual loss. That would be a regular business loss. That would be a negative at the end of your T21-25. What we're talking about here, the difference is that we're talking about, scribble on here, we're talking about an investment loss. The key difference here is it's money you invested in a qualifying business. So this is treated similar to a capital loss. This means you've it's treated differently, but it would be kind of under the same category. You've invested, you've put capital into something, and you've lost it. So the way that this is created is because you have disposed of shares or debt in what we would define as a small business corporation. So what is a small business corporation? Small business corporation is a CCPC, so Canadian controlled private corporation. You have to have 90% or more of the fair market value of the assets being used in active to produce active business income. So in other words, this shouldn't be just an investment business. This should be an active business that is engaging in some sort of trade. And the last one, more than 50% of it happening in Canada. So what this is all about, one of the themes that you'll see when thinking about tax is, or when we're looking at giving special or preferential treatment to somebody through the tax legislation, if it's Canadian, if it's private, right? Private, closely held, not a public company, and if the business is active. Those are the 3 things you're going to be looking for. When you see those, you know there's potentially going to be some relief on the taxes. Now, why would we do that? Well, obviously, we don't want to give a bunch of Canadian tax breaks to companies that are controlled by or operating in other countries. Our goal would be to reduce tax for Canadians. So that's one. So we've got the control factor and where is it happening. Part 2 is active business. When you think about active business is going to create more jobs. So we want to promote or reduce the tax burden on entities that are job creators. We want to help them so we can create jobs, better for the economy. So that there's built into these rules, there's kind of, certain goals. And being a private company, that just means it's going to be small. So we want to support small business to give them a chance to grow versus having these tax advantages for a big public company that's working with a lot of cash, has a lot of capital invested that they can use. So when you see those things, that's when you're going to see some preferential tax treatment. So these kind of concepts will carry over as we get into the small business deduction for corporations. But we're still talking about individuals. And this is when individuals invest in a business through either shares or debt. So they either buy shares or they loan it money. Now, here's where the special characteristic comes in. The special thing about this is that it can be deducted against any type of income. So we know that our capital losses, we just talked about this last class, we reiterated it, our capital losses can only be claimed against capital gains. All of our other losses can also be claimed against capital gains, but capital losses can only. So what that means is we get kind of stuck. If you have a $100,000 loss and then you don't get any future capital gains and you don't have any in the last 3 years, that loss in theory could just sit there and go unused until the death of the taxpayer. And we talked a little bit about that last class, what would happen then. So that's the special characteristic. So in other words, if you qualify for this and you have one of these losses, you could apply this against your employment income. So one more thing I should mention before I give an example here. So this still, though, the characteristic that continues is only 1/2 of this is allowable. So the same as a capital loss or a capital gain, the inclusion rate is 1/2. We call that, what people in the industry will commonly call these Zabel losses. So it's an allowable business investment loss. The allowable portion is 50%. So if somebody had a business investment loss of 100K, that, if it qualified, all of these things, that would give them an able loss of 50K. That 50K could be applied against any other source of income. It doesn't have to be a capital gain. So if you had employment income of 50K in that year, you could claim this whole loss against this whole income and get all of your tax money for the year back. So this can be a pretty big impact on a tax return, and it would all come in the year that the loss occurs. So in other words, when you dispose of the shares or the debt, that's when it would happen. So if you bought the shares for, say, well, we called this a loss of 100. So say you bought them for 200 and you sell them for 100. You have a loss of 100K in the year you sold the shares. If you guys have any questions, feel free to throw them in the chat. Hop on mic. No worries about interrupting. Whenever you guys have a question, throw it right in there. So that's another type of loss to throw into the mix. So your job is going to be, when you're looking at these things, to know to classify them in the right place and give them the proper tax treatment. So must be deducted in the year that it's realized, as much as you have income. In this example here, I said, well, if you had the 50K, perfect. You can swallow it all up. You have to use all of it. That's a rule. You don't get to eliminate, say, the 13,000 for your BPA. You don't get to do that. You have to use as much as you can. So in this case, you'd use it all, you'd get to zero. But if your employment income was the only income you had and it was only 25, you could only use the 25 in the year. You would have to use that. And in that case, then you would have an additional 25 left over. So those unused amounts become a non-capital loss carryover. So that's the good news. So that means because they're non-capital, they continue to be able to be applied against anything. Your net capital can only go against capital gains. Your non-capital can go against anything. Your business investment losses can go against anything. So they keep that characteristic. That's the unique thing about a business investment loss, which is different than a capital loss. Now, we can go back 3 years or forward only 10, not the 20 years that you'd normally get for a non-capital. So they become this weird kind of hybrid. So you start out with the business investment loss, you claim as much of it as you can in the first year. Then it converts to become part of your non-capital loss, but you can only carry it forward for 10. Then after the 10 years, well, guess what happens? It turns into a net capital loss, and then it's carried forward until the death of the taxpayer. So this is a little bit of a changeling. It morphs here into different things through its life cycle potentially. Now, another thing that happens is the ABLEs can affect other things. One thing that they can affect is the lifetime capital gains deduction. Now, I think, let's get into that. I'm just going to skip ahead because we've mentioned this lifetime capital gains deduction a few times. But before we talk about how it interacts with the ABLEs, let's go ahead and explain what the heck it is. So lifetime capital gains deduction is something that's been around since 1985. There's a little bit of a life cycle here for it, so you can have that for interest. It was originally, or at least it currently, I should say, but back in 2014, we hit the amount 800,000, but they set up to index it moving forward. So a lot of things will be indexed, and that's what causes our rates and things to change every single year. So that just means we're going to factor in inflation. So we set it at 800 back in 2014, but we're going to keep increasing it a little bit every year. So all the way here in 2020, we've actually hit 883, 384. That's the current rate for the year 2020, based off of an original 800,000. This same thing is a little different for farm and fishing properties. It's just fixed at $1 million. It was put in at $1 million in 2015. So that's a little bit of the history of it, but let's get into the mechanics. So the first thing, whenever we look at different benefits and things, we have to find out, back in chapter 4, when we learned about tax credits, the first thing we would do is go, do we qualify? So you have to do an evaluation to determine if you qualify for whatever that special treatment is. So in order to qualify for a lifetime capital gains deduction, first of all, we have to have a small business. They have to be small business corporation shares that we are, and by the way, we're talking about disposing. of these. So with the able loss or the business investment loss, we were disposing of the small business shares at a loss. Here, we're talking about disposing of things at a profit to create a capital gain. And we're looking for an exemption so we don't have to pay tax on that. So first off, they need to be classified as SBC shares or farm property or fishing property. So those are the three that will get this treatment. So let me just to give a little bit more context to this too. Lifetime capital gains deduction. So what we're saying is that you can, for small business shares, sell those shares at a gain of $883,384 and not pay any tax on them. So if we wanted to use simple numbers and we'll say you bought the shares for $883,384 and then you let's do this. I'm gonna do this math easy so I don't have to pull a calculator out. So if you bought the shares for $1 million and then you sold them for $1,883,384, creating a gain of $883,384, you can use this one-time lifetime amount to remove the gain fully and pay no tax on that transaction. So that sounds great, but it's only for qualifying transactions. This does not apply to, you bought some shares, you sold some shares, that kind of stuff. That's not what we're talking about here. So that's what sometimes people will hear this and go, oh, there's a lifetime capital gains deduction. I can profit $883,000, and not pay any tax. That's not correct. It's for very specific investments. And the reason being, because the reason why this rule would be in place is to encourage investment in these categories. So to encourage people to risk their money in a small business, they'll give you a tax benefit to your treatment when you win and a tax benefit to your treatment when you lose. So that's what the able loss is. So this is the flip side for when you're winning. Now, what we will find out though, is that you can't double dip. So if you're going to take a benefit when you win, that eats up some of your space, if you're going to take a benefit when you lose, that eats up some of the space that you could use when you win. So we'll get into the mechanics of that. But these two, you can think about them a little bit as two sides of the same coin. The able loss and the lifetime capital gains deduction. And this is a deduction because what we'll do is we'll show the gain as part of our income, but then we will deduct it for tax purposes. When we're going from net income for tax to taxable income, this guy's going to be right in the middle. So the qualifying property is going to be our small business shares, farm property, or fishing property. Small business corporation being defined as a CCPC with active business, substantially all of the assets, 90% or more, are in active business. And that active business is happening primarily in Canada, at least 50%. So that lingo, the word primarily means half or more. There's a significant chunk of what you're doing is in active business. Is in Canada in this case. Now, you could sometimes have a company, sometimes these can get complicated structures and there could be a holding company that owns the active company. So it could be a company that owns shares in a company that qualifies, that sort of thing. So it can get a little more complicated. That's why it says includes shares of another SBC. So this could get more complicated, but in the basic example, You want a Canadian controlled private corporation. So in other words, not public, not from another country. We're looking for CCPCs. And actively using their assets, substantial amount of their assets, primarily in Canada. There is a time frame that has to qualify here too. So it has to be not owned by anybody else in the preceding 24 months. So this isn't something that you can kind of do on a whim, like you're just flipping, you're buying it, flipping it, that sort of thing. You have to have invested and held that investment for at least the preceding 24 months. Also, that company had to be active, or at least 50% or more active for those same 24 months. So this is kind of trying to work against people getting strategic and, just kind of changing the business characteristics at the last moment before they make the sale, like basically prepping it up to qualify for this treatment at the last minute. It has to have been behaving this way for 2 full years before it would qualify. Just looking at Patrick's question, would that mean we have to own 90% of the shares? So no, you can own any. So no, the 90%, let's go back to this. So what this means by substantially all of the assets, that means that the company, the corporation's assets need to be substantially used in active business. In other words, their assets aren't a bunch of rental properties, say, as an example. If they had, 33%, just to throw out a number, if 33% of their assets were in real estate holdings that were being used for rental, unassociated with this business altogether, then that they wouldn't apply for this deduction, where they wouldn't qualify. You could own 1 share and be disposing of 1 share. You could own all the shares. You could own 10% of the shares. So there's no requirement on you as to how much you own. It's more about the characteristics of that company that it qualifies, that it would be considered an SBC. And so the 24 months is just, to give a good space of time that you're not just taking a company that didn't qualify, converting it into one that did, in order to take advantage of this, doing it at the last minute. So you have to operate that way for a full 2 years. So another thing to point out here, that number 883,384, that's the real world gain. I like to call it the real world. That's, like I said, you bought it for $1 million and you sold it for $1,883,384. You profited $883,384. So that's the real world money in your hand. Because that's considered a capital gain, we already know that there's already preferential treatment for capital gains. You have an inclusion rate of 1/2. So you were only going to pay tax on 1/2 of that to begin with. This is taking care of the rest. So that 883,384 is the real world amount, which effectively is a taxable amount you're covering of 441,692. So I guess when you call it 883,384 or the $1 million for fishing, you are already only going to pay tax on a half of it. So that makes it sound a little bit better than it really is, but still very powerful. So if you've got this business that you've built, this could be your own business, right? That you've created, and you want to be able to sell it and do that in a tax efficient way at the end. So if you sell the shares of a qualifying corporation, you don't have to pay tax on that first 883 of profit. You already didn't have to pay tax on half of it, but now you don't have to pay tax on the other half either, as long as it qualifies. So this can be important in tax planning, as far as what you're going to be doing with your assets and things like that. And this can get a little complicated, but ultimately, this active business, substantially all of your assets involved in active business. So you could still have a building, but the building would be the building that your company operates out of, that sort of thing. But if you're going to also buy a bunch of rental properties or something, you wouldn't want them to be inside this corporation. Do that in a separate corporation. So you want to make sure that your corporation, if you want to be able to take advantage of this, is meeting these guidelines. So that's to be a tax planning thing to keep in mind. So there's a calculation for how we would figure this amount out. So you're going to have an annual gains limit. So this is, you're calculating, this is one of our famous least ofs. So least of number one, the annual gains limit, which is your net taxable capital gains for the year, less net capital loss carryovers deducted, meaning the ones that you're claiming in the year. Now here's where the ABLs come in. Less ABLs realized during the year, this one's tricky, whether or not deducted. So in this case, we don't care if they were deducted or not. If you've got an ABL that you've realized, right, even if you couldn't say you couldn't use it all, half of it was carried forward, doesn't matter. The whole amount you realized is going to be subtracted from your annual limit. And again, we're only doing this once a year. This is something that's just going to be on your tax return once a year. So you have to figure out what's my limit for the year of how much of this I can use. So you'll notice it's clearly going to be affected by what gains you have in the first place. But it's also going to be affected by ABL losses. And again, the thought behind the ABL losses and the capital gains exemption, the reason why they interact is because they're kind of like two sides of the same coin. You're getting a preferential treatment if you invest in a small business corporation and lose, and you're getting a preferential treatment if you invest and you win. If you win, you can get rid of that other 50% of the gain and not have to pay tax on it, or at least a portion of it. And then if you lose, you can have that loss be treated as a loss. It's still cut in half to 50%, but you can apply it against any type of income. You don't have to hold on to it to put against other capital. So you get a preferential treatment on either side, and we're going to have to not let you double up, I guess. If you use one, it eats into your limit for the other. Now let's skip over this for a second. The next one, so this is part 2, least of. So if you're doing a question with this, you got to calculate all 3 of these and then pick the least of. So this one is your cumulative gains limit. So this is going to include the sum, the total of all annual gains after the year 1984. less any capital gains deductions you have claimed in the past, less this guy, which is your cumulative net investment loss, CNL. If there's none of that, then the cumulative gains limit will generally be the same as the annual gains limit. So this cumulative gains limit is going to be affected by this guy here. Now, what the heck is that? Cumulative net investment loss. This is, well, what we're going to add to it is, so there's the word investment. So we think about our investment income from back in chapter 7. Interest, rent, dividends, these were all our investment incomes. Also included in here, rental property, all that stuff. There's some other stuff here, but that's the main ones. Less any losses from rental, maybe interest deductions, you know, you're paying interest on a property or something like that, that you were using to deduct from that income. Financing costs used in the limited partnership interest, a bunch of this stuff. So you guys don't have to worry too much about the calculation of this. If there's any calculations of them, they'll be pretty basic. And in a lot of cases, you'll just be given the CNL. So it's not something you have to worry too much about the calculation, getting into the technicalities of it. But you have to remember to subtract it here. Oh, and the last one here, I guess it doesn't come up as a slide, least of. So it's the least of your annual gains limit. I don't think there was a slide. Oh, I missed it. Sorry, let's do this again. This is number 1, or we can call it number 3 because we have all the other ones 1 and 2. Sorry. The unused portion, right? So this 883,384 is literally your lifetime amount. So you could use 100 of it this year, 100 of it next year. You can chip away at it over your lifetime. So that's your pot that you have to work from for your whole life. Once you've used it up, it's gone. It's indexed, so a little bit more could be added to the pot. But if you use that whole 883,384 in 2020, now you're down to 0. So we have to obviously consider what's left in your pot as well. We can't obviously use it if we've already used it. So the least of the 3 items, the unused portion of the maximum, your annual gains limit, and your cumulative gains limit. So it's the least of those 3. So if you're working on one of these questions, you have to calculate all 3 of those and then choose the lowest. Always show all your work getting to that point, even if it's obvious which one it's going to be. Do the work to get through all 3. So let's go ahead and have a look at this in an example. So we can have a look at a scenario and see how we would calculate these. So in this case, we have an individual. They have a $20,000 taxable capital gain in 2020. So make sure you're really clear in these problems and things that you know what number you're looking at. Read the questions carefully so that you know what you're dealing with. So when it says taxable capital gain, that means we've already cut it in half. So this would have been a, let's scribble on here, right? This would have been a $40,000 real world gain. The taxable portion is 20. If this had said a $40,000 capital gain, you know that only 20 would be taxable. So be careful, you know what number they've given you. So in this case, we have an individual with a $20,000 taxable capital gain, which occurred in 2020. This was on the disposition of qualified small business corporation. So we've been told in the question, they qualify. We didn't have to get into an assessment of that. We know that they qualify. So it says he deducted a taxable capital gain of $6,000, which related to 1/2 of 12. So again, he deducted a taxable capital gain way back in 2013. So what that means is that this taxpayer used some lifetime capital gains back in 2013. So he had a little $12,000 gain and he ate up the $6,000 that would have been taxable using his lifetime capital gains. Also, we have a net capital loss carry forward from back in 2020 of $9,000. So that's those same net capital loss carry forwards we learned about last class. But we've got some of that sitting in the pot. And again, whenever we're looking at a tax situation, part of our due diligence is to get into CRA and find out what's on file for all these carry forward losses. Make sure that what we have or what CRA has is that they agree with us before we go ahead and do any filings. Now, one of the things, just on a practical standpoint from this, I've seen this even just in the last couple of weeks, I ran into this situation. We were doing a corporate tax return and the taxpayer had done it themselves for the last few years. And things got a little complicated or something. They asked us to come in and take care of their year end and do the taxes. And when I looked at it, I saw, there was a significant loss carry forward at the end of the previous year. And I thought, that's great. It wasn't quite enough to eat up the profits we had in the current year. So we were going to have to pay tax for the first time in a couple of years. And I thought to myself, that's too bad. We're close, but we still have a tax bill. But then as part of my due diligence, I got registered with CRA as a representative. I went in and I looked to see what does CRA have for a loss carry forward. And lo and behold, there was about a $30,000 difference to the better, meaning CRA actually had a higher number than what the taxpayer thought they had. So if I had asked the taxpayer, they would have looked at their tax return and said, it's 40,000. When I go to CRA, I look and it's like, whoa, it's 80,000 or 70,000 or whatever it was. So we were able to get enough to cover all the taxes for the year and carry some more forward for next year because we went ahead and did the due diligence to check and make sure that we had the same number as CRA. So just a little side note that you can't always take the client's word for it or even their tax documents. Make sure that you agree with CRA. In this case, we didn't agree with CRA. We figured out where the mistakes were when the taxpayer had done it themselves, what mistakes they made, and we were able to agree up, and CRA had a better number. So, hey, we weren't really going to argue too much with that anyway. Okay, so back to this question. We got a $28,000 taxable gain, which is going to qualify. In the past, we used $6,000 of our lifetime limit. And in the past, we had it created a net capital loss carry forward, and we have that that we are also deducting in 2020. And there's no CNO in this question, so we don't have to worry about it. But if it was given, we would plug it in. So the unused portion of the deduction, this number is the 1/2. So the 1/2 of the bigger 882 or 883 number is 441,692. So that's coming from the same place. That's just the taxable portion. So that's our starting point, and we've used 6,000. That 6,000 was half of a $12,000 real world gain. So again, just be careful in these questions. Be clear. Are you talking about the 12? Are you talking about the 6? Are you talking about the 883? Are you talking about the 441? At the end of the day, this boils down to the 441 and the 6. That's where we want to get. Just make sure you know what numbers you were given and, half them appropriately if you need to. So all this is saying is you started with a pot of 441 taxable, you used 6, your lifetime pot is now at 435. We can never make a claim more than the lifetime pot. So that's one. Next, we have an annual limit, which is clearly going to tie into how much of a gain do you actually have in the year. We can't use this deduction if we don't have a gain. This doesn't reduce, like go against employment income or any of these other things. This only can be used as a deduction against a qualifying gain. So our annual gains limit is going to say, hey, what gains do we have in the first place? Taxable. The next part to this trick is that, we have a net capital loss carry forward, right? 9,000. So we deduct that in 2020. So if we go back here, this is the less net capital loss carryovers deducted. So this net capital loss carryover that we had was used in the year. So that, whoops. So we have to take that out. Meaning, most simply put, we already reduced this 20 grand by 9 with what we had in our back pocket coming into the year. So there's only 11 left. So the 435 is the lifetime pot we have. The 11 is how much gain we're even talking about in the year to reduce. And then the last one, and we're going to pick the least of all 3 of these. And then the last one is the cumulative gains limit. So if we go back to the slide, which is the just previous one, this is the sum of all annual gains limits every year. So you have an annual gains limit, and we're going to calculate every year and just keep adding them up. So the cumulative gains limit in this case is going to be 6,000. That's the taxable capital gain from back in 2013. In that year, we would have had a limit of 6. Then we have the current year, right, which we had our 11 that we already calculated. So if just to be kind of clear on the bits of this, just so you can see. So this is 2013, caused that one. This 11,000 is what we just calculated for the current year. So this is like 2020. But then we also have here. So sum of all the annual gains limits. So these are our annual gains limit for 2013, for 2020. All the other years would have just been 0. There's no activity that we're told about. Then less CNO, we don't have any, but also less capital gains deduction claimed in previous years. No adjustments for changing inclusion rate. So capital gains deduction claimed in previous years. We're only going to be dealing with 50% inclusion rates. So we claimed that 6,000 in a previous year. So that's also related to 2013. But that's the amount we claimed. So in other words, you had a $6,000 gain, you already used it. So cumulatively, we still only have 11,000 that we can work with. We can't do 17,000 because you already got rid of 6. So it's a little convoluted, but if you break it down step by step, it makes sense. A lot of the CRA stuff when you just look at it, goes, what is all this? This is crazy and complicated. But if you go slow and you look at each piece, they're just being very deliberate to kind of close all the holes and make sure that if you follow that formula, you will get to the correct amount. So they're limiters. They're just putting in limiters. Limit of how much you have in the pot, limit of how much gain you actually have, and limit of how much gain you actually have lifetime that hasn't already been cleared out. So that's what that's all about. So in this case, you pick the least of. So the least of is going to be 11,000. So in other words, they'll be able to reduce that taxable income by 11,000. And next year, there'll be 435, 692, or whatever the annual limit is, minus 6, minus 11. So this whole chapter, chapter 11, it's still talking about personal tax. It is involving the implications of different shares you could own in a corporation and stuff like that. But we're still looking from the perspective of the individual, not so much the corporation. However, as a part of your corporate tax planning, if you're a closely held private company, you're going to want it to qualify for these types of treatments. Now think about this. So if you have, what was our number? What's our number here? Let's go back a few, right here. So the current number for 2020, so this 883, think about this, right? We're trying to interject in tax 2, getting to that next level and thinking about tax planning. How can we use these to our benefit? This limit is for every individual, right? Every taxpayer. It's not for every company. This is for one individual. So if you have, say you had 2 spouses that owned a company together, right? Their finances are all intermingled already. Well, now we've just doubled it. So what is that? 883, 384 times 2. That is 1,766,768. Well, now these numbers are starting to get bigger and bigger, aren't they? So a couple who created their own business, Canadian controlled private corporation, in active business, not just like owning a bunch of rental properties, active business, could sell their company for, like, say they created it themselves, so there's no the cost of the shares is $100, just the nominal thing they paid for the shares or whatever. In a simple case like this, they could profit 1.7 million and change. They could sell their company for 1.7 million and change and pay no tax. So the more shareholders you have, the more you're multiplying this this benefit in relation to the company, in relation to the corporation, because each shareholder comes to the party here with their lifetime exemption. So as far as tax planning for, say a family unit that's getting into a family business, you may want to include multiple shareholders so that you can, if they're all involved with this business and not with anything else, you want to be able to have their lifetime exemption involved in this if the long-term plan is to build the business and sell it. So that's just a little tax planning perspective on this. So this is a powerful tool in the toolkit for saving tax. This is also, when we look at, incorporate or not, this would be a strong future reason to choose to incorporate a company, because this only exists for a qualifying corporation, for the sale, specifically for the sale of qualifying corporate shares. So you can only get that advantage if you're in that format. If you're self-employed, filing your T2125s, there's none of this for you. You're going to sell your business. It would still be considered a capital sale, but you would have to pay tax on the 50% gain. So you'd still have to pay tax in this example if you sold it for 1.7 or half of that. So the 850 or 883 or whatever the exact numbers were. So big advantage strategically to incorporate your company if there's that potential for growth, if that's your plan. Let me just check these next couple slides. Yeah, so what if we just scoot back here? And I just want to mention one other thing here. So when we go back to our able loss, this was where we jumped from. There is an effect on your lifetime capital gains deduction of the able. Because again, I like to think of these as two sides of the same coin. You've invested in a small business. Did you win or did you lose? Now for the ables, you can be disposing of both shares or a loan. So you could have just loaned the money to the small business. So it doesn't actually even have to be shares. So it's still a little different, but I just like to think of it conceptually as a bit of the two sides of one coin. So what happens is when you realize a business investment loss, that will reduce your ability, reduce your ability to take advantage of the lifetime capital gains deduction. So to the extent that a deduction has been made, the equivalent portion of the loss will be disallowed. So what this means, when it's disallowed, it's just going to be treated like an ordinary capital loss. So again, the big benefit of the able is that you get to claim it against anything. Scribble this down. Against anything, any source of income, all of our sources of income. We don't have to put that loss against a capital gain. So when we say disallow, we just mean disallowing the special, we're disallowing the special treatment. Now, that can cause problems though, if you're not aware of it, if you don't have that in your tax plan, or if you file inappropriately. So I'll give you an example. I had a client that came to me a number of years ago, could be 5-6 years ago, I think maybe. And they were, they had been into boat building and they had sold their company. So when they sold that boat building company, they had taken advantage, their tax preparer, rightfully so, claimed a significant portion into their lifetime capital gains exemption. So that way they had reduced the amount of tax or paid no tax when they sold their business. So good for them, they were able to make that profit and not pay tax. Jump forward, say 10 years or so, and everybody's forgotten about that. And maybe there's a new tax preparer, and that new tax preparer, so this is, you know, one before us, but there was maybe say another one before that. So this next tax preparer doesn't do their due diligence, does not look to see what claims have occurred for capital gains exemption, perhaps was unaware that this existed, and went ahead and, you know, they were aware of able losses and claimed an able loss for the same client for another business that they were disposing of. So they claimed able loss, got a big refund. Everything's great. But then, lo and behold, CRA comes in with a letter that says, hey, we looked at this ABLE loss. We have to, quote unquote, disallow it, meaning put it into the capital stream. And so your taxes are going up. Here's your new tax bill because we gave you too big of a refund. So the reason why this happened, and the tax preparer at the time and the client, nobody knew anything. What is all this about? They didn't understand it. It's set for a year or so, couldn't get resolved. So finally the taxpayer came to me and said, hey, we've been dealing with this guy. He's not solving the problem. He filed this thing. We thought, we received a big refund. Now they're sending us a bill. This is a whole big mess. Can you fix this for us? So I said, all right, let me take a look at it. So I was able to figure it out, but unfortunately the reality was I had to break it to them that this decision by CRA was correct. They were claiming an ABLE loss, which is fine, except they had previously claimed capital gains exemption. And to the extent that they had done that, they would have to reduce their ABLE loss. So that reduced the ABLE loss they were able to claim. So I had to kind of walk them down and give them a little education on this topic, but it ultimately explained to them, unfortunately, this is true. Now, there's nothing we can do about it. Your previous tax preparer, if they understood how this works, would have known that as a part of their due diligence, they needed to check and see what capital gains exemptions had been claimed, because that was going to affect this. So to the extent that a deduction has been made under capital gains exemption, right, 110.6, the equivalent portion of the loss will be disallowed. So you can claim it, but a portion is going to get disallowed, meaning put into your capital loss carry forward. Now, unfortunately, this, if I had a magic here, maybe it would be to take that capital loss and apply it against some other capital gain or something, but they didn't have anything to apply it to. So all we could do is say, all right, well, now we have this in our back pocket for the future if you sell any assets. So, that didn't make them feel that good, but all I could do is at least explain to them, what this was, what occurred, why it occurred, and everything else. So this is a cautionary tale on, I guess, one, knowing what you don't know, and two, going ahead and making sure to always do that diligence, and don't just ask the client. Who knows? I don't know what conversations were had. They might have said, hey, have you used capital gains exemption? They might have said, oh, no, we never did that. But they did 10 years ago and they forgot or something, or they didn't really understand it at the time. So you can never rely on the client. You need to go to CRA, see what those, and that's very easy to do in 2021, very easy to do. You get authorized, you log in online, you open up, there's just a section in there that has all the carry forward information. Now, if you don't agree with CRA's carry forward information and you need to get that adjusted, well, that's a whole nother thing. But if what you see in there is correct and you agree with it, and you're all on the same page, then that's what you need to base your filings off of. So that's a little cautionary tale on that. So the ABLEs are going to be converted to capital loss. You can't claim them to the extent you've previously claimed. So in other words, they're trying to stop you from double dipping on both sides. Two sides of one coin. It's the best way I can kind of describe that. So let's just go here for a second. So there's an example here for the ABLE. So let's take a quick look at this. Put some numbers and a situation to all that talk. So in 2020, John Brown has an ABLE. So that's the allowable portion. That's already 1/2. So an ABLE loss of, I know that sounds silly, allowable investment loss, but people kind of refer to them as an ABLE loss or an ABLE. So we have an ABLE of 66,000, net taxable capital gains of 14, and other non-capital sources of income. So this is this could be anything. It could be employment income, rental property, whatever. Everything that's not capital. 20 grand. In previous years, that's the key, just like my client, in previous years, they had deducted something under the lifetime capital gains provisions. So in the past, they took 22.5 out. So that's under section 110.6. We have to know everything they took out in the past because that's a lifetime thing. It just keeps adding up. How much have you claimed? So if we have an ABLE of 66,000, we have to reduce that ABLE before we make our claim. We have to reduce it by what we've done in the past for capital gains exemption. That's the 22.5. So the allowable amount's going to be 43.5. We have non-capital income. So the good thing about ABLEs, we can apply them against any type of income. So we want to use them against this non-capital income, 20,000. But then we have an unused portion. So we're going to get rid of 20, but we're going to carry forward into the future 23.5. This is going to be initially considered non-capital. That, as we mentioned before, that's for 10 years, not the 20. So you don't get the full item. Oh, here it is right here. Forward for 10. Now you can still go back 3. If you're trying to remember, it's always back 3. Forward 10 for ABLEs, 20 for non-capital, and until death for your net capital. So after the 10 years, it becomes net capital and then carried to the death of the taxpayer. So this carry forward happens, and the and also we have the amount that was disallowed, right? So which slide was that on? Yeah, so the disallowed portion is treated as an ordinary capital loss. So this one is going to non, and this one is going to capital loss. So a lot of things going on here, right? That's getting carried forward, and that's getting carried forward. The stuff we couldn't use, right? Which is basically what the 46,000. So ultimately here, we used 20, and we carried, oops, sorry, that's scribbly, and we carried 46. And that's because we couldn't use the 22.5 because we had previously claimed lifetime capital gains. We couldn't use the 23.5 because we only had 20 of non-capital income. So in the example of my client, the part that the tax preparer, sorry, had missed, I think, honestly, after looking into it, they weren't aware of this at all. And so then they couldn't really figure it out. And they, after the fact or before the fact, but this is exactly this bit right here. If they had the knowledge and had done the due diligence, they would have already known that and would have filed with it and wouldn't have had it disallowed. So anyways, the only good thing I could tell that client is, well, you know, you still have this in your back pocket. Go sell something and get a capital gain and we'll use it then. I'm not gonna, so there's stuff here for, let's see here. So we did, you know, there's the first part there. So that's your unused, your disallowed ABLE. In this case, what did we have here? I forgot. We have one more piece to this puzzle. There's a second part. we had capital gains. So we're actually, this 22.5 that we're going to treat as a capital loss, right there, we can absorb the 14 of gains. And then it's actually 8,500 will carry forward. And our unused able, that's still the 23.5. We're just going to carry that forward. So there actually was a little bit more to this story. We actually had some current year capital gains, so we could just chew those up right away. Unfortunately, my client didn't have those, so we couldn't take any advantage of that. That would have been a good solution, or at least a good help to the new tax bill that they had. That's always, it's unfortunate when a taxpayer, if the tax preparer makes a mistake and it causes a larger than it should have been refund, because then the taxpayer gets the money, maybe spends the money, and then 6, 7, 8 months down the road, they find out, oh, I wasn't supposed to get that money, now I have to pay it back. So that's never a pleasant situation anyway. So there's similar stuff in here for farming and fishing. You guys can read about that. I'm not going to get into it there in detail, but this also, suffice to say, also for farming, also for fishing, and those are at $1 million. Those ones aren't indexed. They could change the amount, but that's at 1 million. So I know I've been moving all around this slideshow. So let's see here. So I'm going to, let's see. So the last thing I'll say, and then we'll take a little break here. It's about 6:43. So last thing I'll say here, there's some stuff there in the text about ordering rules. So when we have all these different deductions and losses and things, you may look at it and say, well, what do I want to claim first, or what should I claim first? So there's a little bit of guidance there just in the order that you would claim things. So you're going to get rid of non-capital first because it expires, right? And it also applies to everything, so use it up. You got your non-capital, or sorry, this is the positive, I meant to underline this one here. Those losses and things, you're going to grab those first. There's some ordering here when you're getting this. This is that list between net income for tax and taxable income. So stock options, then lump sums, then your loss carryovers in order incurred, meaning you're going to use the oldest stuff first, because you actually do on the tax return say, I'm using the losses from 2012 or whatever. So if they are ones that are going to expire, you certainly want to make sure to use the right years before they expire, if they're non-capital. And then you would use your lifetime capital gains after that, because that never expires. So save that till the end. That's just a little bit planning wise of how you would order those losses. So let's, it's 6:44. Let's take a break until 7 o'clock. And then at 7, we'll come back and we will talk about tax on split income. And we will finish up chapter 11. Oh, there's one question here from Patrick. Where does the able of 20,000 come from? So the 20,000 was our non-capital income. So in other words, non-capital income here, this could be, let's just call it for sake of argument, let's say it was employment income as an example. So this person's an employee and they got a T4, they have some employment income. The benefit about ables is you can claim them against that type of income. You don't have to hold them for capital gains. So when we pop over here, this able, that's how much we are claiming for the able. In other words, the able can only be claimed in the amount of 20,000 because that's our non-capital income that we want to apply it to. So step one, we had to limit the actual able was 66. We had to limit it based on our previous claims for lifetime capital gains. But then we only had 20 to actually put it against, right? So we had 43.5 that was allowed, but we didn't have 43.5 of income. So in other words, if the income had been 100,000, then we would have used all 43.5. Then the unused portion got carried forward. So if our income was 43.5 or above, we wouldn't have had anything to carry forward. As far as this, we still would have always had the 22.5 because that's turning into a capital loss. We're converting here. Part of the able gets converted to a capital loss to the extent that you've previously claimed lifetime capital gains. All right, so let's take 15. And when we get back, we will talk TOSI. All right, guys. Thanks. Talk to you soon. All right, guys, let's get started. Hope you had a good break. And let's get back at it. So the next topic, still in chapter 11 here, is called tax on split income. So this is some new legislation or additional legislation to pre-existing legislation, some changes that occurred a couple of years ago. It's a good example of why we have to keep our eye on the ball, why this is a practice, why this is something that we have to, professional development and keeping up to date on your knowledge every year is very important. Changes are always coming in, new legislation, changes to rates. It's not something you can just memorize, walk away from it, and think it's still the same, even 6, 12 months later. So this topic here is called tax on split income, or we would refer to it as TOSI. It's kind of what people call it generally, the little short name. So what this is about, where the text lays it out here like a problem and a solution. So the problem being the use of private corporations as a kind of a tax planning module to split income between related individuals, particularly in a way that the government's going to deem as inappropriate. So they're trying, this was brought in to try to toughen up on income splitting. We know that, we've looked in tax 1 at our personal tax brackets, at those tax rates. We know that as you get up into the higher brackets with the marginal income, in Nova Scotia at the highest bracket, you're going to be paying 54 cents on every dollar. So there's a lot of money to be saved if you can split that income between 2 or more people. So what we had in place before this came in was kind of like some kiddie tax laws related to split income, meaning you can't split half your income with your newborn child, let's say. You had to at least be splitting with an adult. But for anyone under 18, it was just automatic. If that was caught, the income's coming back to you, and that's it, with some punitive treatment. So TOSI takes this a little farther, a step farther, to reach into further rules related to adults trying to split income. So what is this tax on split income? Well, it puts you at the maximum tax rate. This is just the federal portion before the provincial, which is 33%. Also, your tax credits are going to be limited to just dividend tax credits. So you can't apply any of your other tax credits against this income. Even if you had them available, sometimes you have more tax credits than you need and they just expire. You can't use them against this source of income. So really, this is a punitive treatment. So if you try to split the income where you shouldn't be, you're going to get hit. When you get caught, you're going to get a worse treatment than even the regular treatment would have been in the first place, potentially. So that gives a punitive element to try to deter people from even attempting this. So a lot of money can be on the line in this. So here's a little bit of the history. I kind of already mentioned that. So prior to 2018, this was only for under 18. 2018 is when the changes happened. Now this applies to also to adults. The kiddie tax stuff, or whatever, if you want to call it that, came in back in 1999. So the basic concepts here. We have a couple of definitions. We have specified individuals. That's any resident of Canada. And generally, this person is going to be a low-income individual who, this is the person who we're trying to kind of transfer the income to. So they're related to a person who is the source individual. So the source individual is the individual, source individuals are individuals who are related to a source individual. Now, this sounds like a bunch of nonsense, right? But we'll come back and we'll try to make this make sense in the concept of what we're doing here. But generally speaking, you have a source of income and you're trying to move it over to somebody else. So you're going to have potentially somebody who's the source of the income and somebody who's a lower income that you're trying to move it to. There's also a concept called a related business. So the source individual would be actively and regularly engaged in the business. So in other words, it makes sense that that income would come to you because you were the source of it. You were actively working to earn that income. So a related business is one where a source individual is actively, regularly engaged in the business, or if it's a corporation, the source individual owns 10% or more of the issued shares, the fair market value of the issued shares. If it's a partnership, the source individual has any ownership interest. So what we're going to be looking at here, these are going to be questions where you're going to be given a scenario. You have to look at that scenario and try to determine if TOSI would apply based on what you've been given. When we're looking at this in practice, we're trying to make sure that our clients don't fall under these rules. And if they do, that we do not split the income. That we only split the income when they are safe and outside of these rules, or inside of them, whatever way you want to look at it, meaning they're within the guidelines and there won't be any tax on the income. So what are we talking about for the income that we would split? Well, this could be dividends from a private company, shareholder benefits or loans from a business, interest, distributions from a related proprietorship, capital gains, all of this kind of stuff. So basically income that you're trying to split to save tax on coming from a business. So what we're trying to do is figure out ways to be excluded from these rules. And there's a few different ways that this can happen. And so let's move ahead to slide 46 here. So one way is to have the amount be an excluded amount from the TOSI rules. So the amount of money itself, the type of money that was sent is, is excluded. So this will be the case for individuals under 25 if taxable capital gains from a property, if they're having taxable capital gains from a property acquired as the result of the death of a parent or the death of a person, if the individual is either enrolled in full-time post-secondary or eligible for the disability credit. So it's a very specific scenario. And I will say, not to get into a big thing about it here, but generally speaking here, what we're talking about is, when you inherit property and things like that, that's not going to be taxable. When people talk about having to pay tax, for a deceased person, generally speaking, that's not the case. But as that final tax return is prepared, there may be amounts owing before, funds and things can be distributed as part of the will, because the tax man's got to be sorted out first. But what you then receive is not going to be, you don't have to pay tax on what you receive, generally speaking. So excluded amounts, the things that are going to matter here is the age. You'll notice. So we have excluded amounts, that's available to individuals under 25. And then we have excluded business, that's available to an individual 18 and over. So still always, we're talking here about adults. But there is a window between 18 and 25 where we have some restrictions. So under an excluded business, this would be a business where the individual is actively engaged on a regular, continuous, and substantial basis. So in other words, if you are actively engaged on a regular, continuous, and substantial basis, you can get paid. And nobody's going to call this TOSI income. Nobody's going to hit you with those punitive taxes. How do we conclude that you're actively engaged on a regular, continuous, and substantial basis? Well, that first of all needs to be happening in the current year or any 5 previous years. So it needs to be recent. So it can be the current year, in the current year only, or any of the 5 previous years. Just need one of those 5 previous years. The test that we use for this, so people refer to it as a bright line test. This is 20 hours per week, so part-time, if you will. It's difficult to, determine, somebody being actively engaged in the business. Businesses don't always, also, maybe it's a part-time business and you don't even need to work. Maybe it's, 2 spouses, the business only takes 20 hours and you each do 10. So there's going to be exceptions to this. This test doesn't have to be met. But in a full-scale business where it's operating through the year, 20 hours per week is all you need to prove to say that you were actively engaged in the business. So you'd have to back that up somehow with evidence, time tracking records, whatever it was, to prove, satisfactory that you had put that effort in. So what this is trying to do is remove from the equation somebody who is not working in the business at all. Maybe they have another job, they're off working that full time or whatever, or they don't even live in the province where the business is or something like that. Again, all of these things, it all depends. There's a lot of gray area here. You'd really have to look at the scenario because a lot of work could be done just online, just on computer, right? So it doesn't mean you even physically have to be there. So it really depends. There's a lot of it depends in this category. But there is kind of a test to say, well, if you're doing at least 20 hours, we're good. We can prove that, no problem. And this fits for anybody 18 and over. So the business itself can be excluded from this because you're actively engaged with it. So any income you get from that business is free and clear of these rules. And I'm sorry, I might have misspoke on this one. So just to clarify, I feel like I misspoke. So if you did in the current, we're talking about current year income. So if you are active in the current year, you meet these tests, you're fine. Or any 5 previous years. So if it's in the past, it has to be 5 years. If you just didn't happen to be this year, that previous work you did can still count for something. And by the way, this, let's see, in chapter 11 here, do actually have the physical book here. There we are. All of this stuff is kind of broken down. Starts, there it is. Starts on page 527. That's where they start to break this stuff down. So what we're talking about right now, we are talking about excluded business for age 18 and over. So that's on page 531. So have a look at that section, make sure you're clear with how that works. So it talks in there about, it says note that if the business is seasonal, like a landscaping business, the 20 hours per week requirement is only required for the portion of the year which the business operates. So same thing, if you're not operating in the winter, you don't have to be doing 20 hours a week in the winter. It also goes on to mention, that failure to meet that bright line test does not necessarily prevent you from using the excluded business exception. So this would be, depending on the facts of the case, the individual situation. So there's definitely a window for some gray area here. This could get into some court case battles I could foresee. So keep that in mind. This could be an interesting one for that. And again, to clarify there, it is at least 5 prior years, all 5. I think I misspoke on that one. So that's all starts there on 531. And that's being an excluded business. Now, the second one is going to be excluded shares. So this is our second option. So when we're looking at this for clients, we're trying to figure out, can we exclude them based on their participation in the business? Maybe we can exclude them based on the shares. Now, exclusion based on the shares is only available for people age 25 and over. So they got this magical 25. So the shareholder owns at least 10% of the shares. This has to be both as a percentage of market value and voting rights. So this could affect certainly tax planning from the perspective of how you set up a corporation and who's going to hold ownership. So when you're setting it up, you might say, well, geez, we want to have at least 10% of this, including voting rights, so that we can exclude the shares and flow income to the person. So in this case, the corporation cannot be a professional corporation. So there's a lot of these rules are also kind of in place there. In this case, say, well, you're say an accountant or something, and say, well, I'm going to give my wife half of the shares and half of the income, but she's not working. Well, in that case, this, you would not pass this test because of this exception that it can't be a professional corporation. Also, less than 90% of the income in the previous year can't be from the provision of services. So this can't be, so again, this is less than 90% of the income in the previous year from the provision of services. So the type of company is important here. And less than 10% of its income in the previous year from a related business. So we're looking for ways to exclude based on relationship with the business or the share ownership. But there's built into that, there's some other little details. And the age is also important because the excluded business applies for 18 and over, but the excluded shares, it goes even higher. You got to be 25 and over. So they're really trying to get at that magical, I guess, 18 to 25 adult children splitting income with them, while they're uninvolved with the business type situation. They're trying to look at that area and limit what you can do there. We also have something called a reasonableness test. This is for individuals aged 25 and over. So this is a little more broad, and this is just saying, hey, is the income they received reasonable? Now, talk about gray area. Who's to decide what's reasonable? A lot of laws based on what would a reasonable person do or think. So that opens up for gray area. So in this case, we're saying the labor, the work they did, the capital, the money they put into the business, maybe they're risking their own money. Have they assumed business risk? Maybe did they sign for, as a personal guarantor on a loan? It's very difficult to get a business loan, even for large companies and very wealthy people, without putting some form of personal guarantee on that, so that the bank, if it doesn't work out, can come to you personally for the money. So that assumption of business risk could get you past a reasonable test. Like, I'm getting reimbursed because I've put a personal guarantee on $1 million loan. So maybe I don't work 20 hours, but I'm on the line for this $1 million. The reasonableness test is a little different between 18 to 24. So it's more specific about, so again, this was 25 and over. For 18 to 24, we're talking about safe harbor capital return, meaning based on a prescribed interest rate, are you just getting a return on capital that you put in? So only capital contributions are considered, actual money you put in. So you can't, for 18 to 24, you can't use labor, assumption of business risk. It's only capital. So you can get a reasonable return on your capital, that's it. There's excluded amounts for individuals of any age. It's capital gains on qualified property, amounts from property acquired through a marriage breakdown. So once we're talking about divorce, these rules don't apply inside of a divorce with the property being separated and that sort of thing. So it's not that. And also amounts from property acquired as the result of a death of a parent or something like that. You know, you've been willed something that's not the stuff here that we're really trying to get at. Though what the TOSI rules are trying to get at is current year income that you're trying to split amongst a bunch of family members, right? That's what we're trying to eliminate, because we know that can that could drop a tax rate from 50% to 25. That could cut it right in half by spreading it amongst enough people. So they really wanted to cut that back, and a lot of people have done that over the years, and this really kind of shut it down for many industries. And had a lot of people looking at new tax plans. Now, age continues. If your spouse is 65 or over, income received by a spouse of any age, so received by a spouse of any age, if the other spouse is 65 or older. In other words, the income would not have been split income if it had been received by the over 65 spouse. So, you know, they're putting in the 65 or over. Again, you know, we back in chapter 4, we would have talked about different things that are in there, like an age amount for a tax credit. There was some stuff in the text there. We didn't get deep into it, but there's some stuff about being able to income split. Pensioners can split their income, their pension income, up to 50% of it to the other spouse, and that sort of thing. So once you're of kind of retirement age, they ease up on this and will allow a little more splitting of the income. I don't know if it gets in the text here. What does it say? It says, for a number of years, legislation has allowed spouses and common law partners to split pension income. So that's what we talked about back in chapter 9. An individual exemption has been added to TOSI to allow a similar result for amounts that might have otherwise been considered split income. Specifically, split income does not include income received by a spouse of any age if that income would not have been split income if it was received by their spouse who is 65 years of age or older. So, needless to say, this can get kind of complicated, but what you guys are going to be expected in this course, again, we're just kind of dipping our toe in the pool, I like to call it, of a lot of complex topics. So we're going to spend this little bit of time on TOSI, but we're not going to dive in as deep as you could, but we're going to look at some scenarios. So you guys will be expected to be able to analyze some basic scenarios and come up with what that resulting tax treatment would be. So these would be under the category of, you know, just like a short answer question. Is this person going to fall into the TOSI rules or not? And why? Is it an excluded amount? Is it an excluded business? How do they avoid the rules, or how do they fall into them? So here's a little example to get a little bit of practice on the topic here. So we've got our specified individual. So the specified individual receives $18,000 in non-eligible dividends. So that's our chapter 7 stuff. Remember, we had 2 sets of dividends. It's a non-eligible, so it came from a small business income. So our person specified, this is the person we're talking about. The only reason why I call this specified individual, like we're talking about, here's who this income is going to, and we're going to decide if it belongs with them. So a specified individual receives $18,000 in non-eligible dividends from a private company controlled by a source individual. So this company is being controlled by this individual. That's why they're the source. We're looking at them as the source of the income because they control this company. And the money went to this other person, the specified individual. Then we're trying to decide, does that income got to come back to the source individual, or is it okay to stay with the specified individual? Now, it goes on to say, in addition, the specified individual has employment income of $8,500 from her summer job. She has no deductions in the calculation of her taxable income. So, crunch a little bit of numbers here with this. So we have regular tax payable. They would have dividends, gross them up. You guys remember this from back in chapter 7. Add in the employment income. That is our total income. So what would happen if this income is deemed to be split income? How this works, this is going to be the mechanics of what happens if you fall into this trap, so to speak. What happens is, sounds great, it's a deduction. Split income deduction. What that means is you're not going to be allowed to have that income. That income's going back to the source person. So the mechanics are, we deduct it from you. You did receive it, so it's going to go into your income. But we're going to deduct it before net income for tax. So it's going to affect both your net and your taxable. So we do the split income deduction, getting you right back down to $8,500, as if it never happened. And then we could go ahead and calculate your tax and your personal tax credit, whatever. And so you're not going to pay any tax if that's all that's going on. Now, the person, the source person who this is falling back to, for them, they're going to have to pay 33% federal tax on the grossed up amount. So they're going to pay $68.31. And the only tax credit that they can apply, only the dividend tax credit, because these are dividends and they've moved over to them. So you'll notice that these dividends, now this person was at like a 15% tax bracket or whatever. I guess it would have been maybe a little bit more here. Yeah, they wouldn't have paid much tax anyways. But this person, instead of say 15%, this is getting kicked up to 33%. Now we don't know what this person's tax bracket is, but 33 is the highest tax bracket. So unless they were already at the highest tax bracket, ultimately, either way, it's just coming back at the highest tax bracket. So this could be even worse than what they had, or it could be just as bad as it would have been at the start. And in addition to that, they are not going to be able to claim any other tax credits. So if they had extra other tax credits that were available, those are just expiring. The only thing you get to claim is the dividend tax credit. So have a look at this right here. So on that 20 grand, well, actually it was 18 grand in real world money. So on that 18 grand, we're going to pay federally. It would also be provincial, but federally, we're going to pay almost 5 grand in tax on that income. So this is what would happen. So you guys may need to do little basic calculations on the result of what will occur. But you also may be asked to figure out, you know, what do we need to do? You know, what is the situation of this? So let's have a look at this. So let's look at an example. We've got Mr. Bartlett. So Mr. Bartlett's only income consists of 13,000 ineligible dividends. These were received from taxable Canadian corporations. So there would be no tax payable on this amount of dividends for an individual with no other source of income, right? So they're under the basic personal amount. So as a consequence of this income receipt, Mrs. Bartlett is not able to claim a spousal tax credit. Mrs. Bartlett has other income of $25,000. So this is looking at transfer of dividends to a spouse. So these transfers, these situations we're looking at are gonna, normally you're talking about a spouse, children, right? Close family. And I won't get into all the details. It's 7:40. I don't want to spend too much time on this, but you guys can look through the numbers that are going to crunch out here as far as that. So this is a little bit of refresher back to remember what happened in chapter 7. If you need to have a quick look at how dividends were treated. Hasn't been that long if you just did this in the spring. That's some basic calculations around that, what's going to happen. Let's see if there's what we should do right now is probably what I'm going to do is get a couple scenarios here. So you guys probably noticed, here they are. So in the textbook, there's assignment problem 11-4. So I'm just going to bring your attention to that one. That's a couple of examples for you guys to look at in this topic, just to get a little practice on how to run through one of those scenarios. So there's a bunch of different cases. We'll just have a peek at a couple of them, and just as a practice as to how you would approach one of those questions. So let's do this. All right, so let's have a peek at the first case. I'm gonna just read this. So the question starts on page 554. It says, in the following 5 cases, just down at the bottom, one or more taxpayers receive dividends from a private company. For each taxpayer, determine whether the dividends received will be classified as split income. Explain your conclusion. And then we've got some cases that start on page 555. And just by the way, too, the calculations of the tax implications and all that, that stuff is on page 533. So it mentions here, when a specified individual receives or received split income, their tax payable is made up of 2 components. The first component is based on a calculation that removes the specified individual's split income from the total. So that was what we did a minute ago. And then after that, it's calculated separate. It also mentions in the text here that, as you see there, the TOSI can be a very costly tax, can turn what was intended to be a source of tax reduction through income splitting into a situation that actually has a high tax cost. So again, you're moving from what you were trying to do, get somebody down to, say, the lowest tax rate, like 15%, and getting them all the way up to 33. That's just looking at the federal rates. It would be different, province to province. So keep that in mind as well. Just trying to see if there's anything else I should mention to you guys before we hop into the question. That's probably about it. Why don't we just dive into it then here? So on the top of 555, we have case 1. In case 1, we have Sam and Sandra, who are both 23 years old and have been married for 5 years. So they each own 50% So again, the ages are important. So both of these people are 23. They both own 50% of the shares, so share ownership can be important as well. This is a corporation that's actively involved in mobile applications. The shares were acquired in return for nominal investment when the corporation was formed. So, often companies will be formed. You just buy the shares at $1 a piece. You each put in $50. Now you have a company. So that's all that was put into this business. So nobody invested a significant amount of money to get it started. Says all of the shares have the same fair market value and the same voting rights. You could have 50-50 common shares, but only 50 of them have voting rights. You might have one person that has all the voting rights and all the control. So you have to consider that as well when we're looking at this. In this case, looks pretty straightforward, 50-50. They both probably put in $50. They're 23 years old, and their shares are all the same voting rights, same market value. Says that Sam works full-time for another corporation, while Sandra has a part-time job in healthcare. They both spend time managing and operating Mobus. Neither Sam nor Sandra work more than 20 hours per week in the business. However, the nature of the corporation's business is such that additional employees are not required. So in other words, they don't need to work, the 20, but they're both working in the business. It says during 2020, because its applications have been very successful, Mobus was able to pay dividends of $200,000. So they split those dividends $100,000 each. So when we look at this case, when we think about that bright line test, we say, we want to just have this an excluded business and not worry about it because everybody's working in it. We don't achieve the 20. However, it's clear, this is a very short little blurb, but we can assume from everything we've read here, there's nothing to lead us to believe that they're not both actively engaged in the activities of the business. There are no other employees. They are the two that are working. So this seems to be that it's very clear they're both actively engaged. So in this case, we would say this isn't split income. It's okay. They started a business together. They're both involved. They're both adults, right? They're both over 18. So none of this money is being split to a child, right? So that matters too. So I would say the critical items here are that they are both adults and they're both actively engaged. So in this case, they would not be classified as split income. And what we would be using for this is the excluded business criteria. If anybody has any questions, as always, feel free to just jump in and ask away. So that one I think was pretty straightforward. Let's have a peek at number 2. So number 2 is GoGreen, a Canadian private corporation that runs a seasonal landscaping business. The business operates from May 1 through September 30th. 90% of the shares are owned by John Go, with his twin children, Max and Mary Go, owning the remaining 10%. So they're 5 each. So we've got John with 90, Max and Mary 5 each. So the twins, Max and Mary, are 22 years old. So we've covered one bar here. They're not children, so they're 22. Says they're attending university in another city during the period from mid-September to the end of April. During May to mid-September, they were full-time operating the GoGreen business. So here's your landscaping example, right? So you don't need to be there in the winter. We're not doing landscaping in the winter, but they're actually working full-time. So I'm going to assume full-time means 40 hours a week. It says during 2020, each twin receives $10,000 in dividends from GoGreen. So 10,000 in dividends each, so 20 each. So they had 5% each. So first, when we're trying to see, how are we going to potentially exclude this, the first thing you want to do is look at the age. So they're both adults, so we pass that barrier, right? So once we know they're adults, we know that they can qualify for some of these exceptions. So in this case, the first one we would look for, if you were kind of going in order, the first thing I would look for would be to qualify. I just want to see if I can get this up here so I can point to where it is again. So the first thing, so on page 531, you see the heading excluded amounts for individuals 18 and over. That's where you want to start at excluded business. Just start there. That's the easiest. All you got to do is be over 18. And then, are you actively engaged in the business? So you don't even have to get into thinking about excluded shares. Start with the low-hanging fruit, if you will. So Max and Mary are both adults. They both easily meet the 20 hours per week during the season it operates. They're doing 40. So the fact that they're going to university and all that is irrelevant. That's not during the operating season. They're clearly involved in the business in a continuous and substantial basis. So those dividends are going to be excluded from this rule under that excluded business. So let's have a peek at the next one. I think, again, that was fairly straightforward for both of those. Not too bad. Just follow the logic through. So let's have a peek at the next one. Roll this down a little bit. Let's have a peek at case 3. So in case 3, we have Edward and Elsie Cole. It says they were married in 2007. Elsie has been the family's primary breadwinner, a role she's satisfied by operating Cole Industries, a Canadian private company involved in an active business. It says Elsie was the sole shareholder of the company and worked full-time in its operations. In late 2019, citing irreconcilable differences, the couple divorced. As a part of the settlement agreement, Elsie was required to have Cole Industries issue a second class of shares to Edward. During 2020, as required by the divorce decree, these shares paid dividend to Edward in the amount of $50,000. So remember, we mentioned that there was a special exclusion here when the property transferred is part of a separation agreement, the breakdown of a marriage. So again, this one's pretty straightforward. That's just an exception. So those would be considered excluded amounts for that reason. Let's hop to number 4. We might as well go through them all here. We're almost there. Case 4. We have Larry and Louise Martin. They own 95% and 5% respectively. So Larry 95, Louise 5 of Muskin Enterprises, a Canadian private company. Larry is 66 and Louise is 59. They've been married for over 20 years. So their ages, again, ages can be very important, are very important under this legislation. Another, again, when you're doing a tax return, one of the first things you need to do is get everybody's birthday, right? You need their birth dates. You need proper birth dates. Make sure you have those because a lot of things can change on a tax return due to birth dates. Birth date isn't something that you want to just pop in at the end. You need to know these things can, particularly, whether people are adults or whether they are 65 or over. In the middle, not so much. So from 2007, when Muskin started operations and until 2019, Larry worked full-time in the business. So 2007 up to 2019, he's full-time. In 2019, Larry retired and turned operation of the business over to a salaried manager. So an employee took over. Louise was never involved in the business. So she's not getting any exceptions based on working in the business. We got to look for it somewhere else. It says during 2020, Muskin pays dividends of $190,000 to Larry and $10,000 to Louise. So that follows suit with the 95% and 5% of shares. So how are we going to figure this one out? So the first thing that cues my mind here is their ages. We've got Larry as the quote unquote source person at 66 and Louise as the specified person, or we're looking at both of them. She's 59. So the dividends received by Larry, well, there's no issue there with split income for him. It'd be an excluded business for him. He's been actively engaged, continuous manner for way more than 5 years. So not a problem. With respect to Louise, however, for her, it's an age-related situation. So her spouse has obtained the age of 64 before the end of the year. So I'll read this to be clear. So with respect to Louise, her spouse has obtained the age of 64 before the end of the year, and the dividends would have been an excluded amount had they been paid to him. Given this, they are not split income. So he could have taken those dividends himself, and they would have been fine. And he's 65. So in other words, he could have split that to her anyways. I guess you could kind of look at it like that, meaning that because of his age, the theory being. So they're fine with that kind of splitting at that age. And let's check the last one, case number 5. So Donald Rump, cute name, Donald Rump owned all of the shares of Dontar during the period 2012 through 2019, 100% ownership. It's a private Canadian company involved in active business in manufacturing. Donald has worked full-time in the business since its inception in 2012. After graduating from high school at 18 years of age, Donald's son David worked full-time in the business during the years 2017 to 2019. However, in January 2020, he enrolled in a full-time university program and no longer spends any time working in the business. He is 22 years old at the end of 2019. In late 2019, in order to assist David with the cost of attending university. Now, this is something that can come up. Business owners will be like, well, I gotta pay for the kids' university now. How can I do this without, in a tax effective way? Can I pay them, can I deduct this payment, or can I do this or that? So this is not an odd thing to come up. So in late 2019, this is what he did. In order to assist David with the cost of attending university, Donald issued another set of shares to his son, and then David used his savings to acquire those shares. So he actually bought those shares with his own money. It says these new shares have a fair market value equal to 20% of the total value of all the outstanding shares. They pay dividends at an annual rate of 5%. They're non-voting. Assume the basic prescribed rate is 2% throughout 2020. It says during 2020, Dontar pays $105,000 in dividends to Donald and $6,000 to David. So they figured out a way to get David this money in a tax efficient way and get him the $6,000 he needed to go towards university. Doesn't sound like quite enough to pay for it, but I'm not sure where he's going. So this one has got a little more meat on the bone, right? So we obviously want to look at the ages. So everybody's an adult. However, David, that's the son, David, I believe where were we at? Was he 22? He's 22. So he's not over 25. So we're limited to any of the things that we can do for the folks that are 24 or 28 to 24. So from Donald's point of view, we want to take the dad first. There's nothing to worry about with him, right? So take him off the table. What we're worried about here is David. Now, David has not been involved in the business, right? He's gone to school. He's also not 25 or older. So we have some limitations there, right? He also wasn't involved in the business in any of those 5 years prior. So we're not going to be able to get anything there. So we can't, if we look at that excluded business option, he's not hitting any of the things we need in order to have this business excluded. If we look at his shares, it said that he has a fair market value of 20%. So that meets the 10%, but he doesn't have any voting shares. So without the voting, and not to mention, he's not old enough, we can't exclude him based on the shares. So we don't have excluded shares. We don't have an excluded business. Is there anything else we have here? So he's between 18 and 24. Remember the reasonableness type stuff? He did put capital. I don't believe it says how much, but it does say he took his own savings and he acquired the shares. So he did invest in the business. So now we're into the reasonableness situation. So now we're into the gray area. He's got a little less that he can argue with because he's in the 18 to 24 group for the reasonableness. So he would need to be able to prove, and we don't have numbers here, but he would need to prove that the 5% that he's receiving, it says pay dividends on an annual rate of 5%. It says that the basic prescribed rate is 2%. So he would have to prove that the 5% was a reasonable return for the money he put in. Otherwise, if he can't prove that, he's going to be limited to that 2%. So he can get the 2% back on what he put in. But everything over and above, in this case, 3%, that would be classified as split income. So this is a little bit of a split decision, if you will, in that he can probably argue for the 2%, but he's going to have to prove more that 5% is reasonable. You can get the 2% easy. The 5%, it's going to be a little more debatable. So that's some examples of how we would work through these TOSI questions and situations. So you guys can expect to be given scenarios that you've got to make some short answers on, potentially calculate those kind of small basic calculations of the split income, the tax that would be assessed. So you see what it actually, because there's a big, it's not technically penalty, I use the word punitive. You're getting hit with a punitive tax rate. And that is meant to deter from doing the situation. So punitive tax rate, as well as not being able to use any of your tax credits against it. So that can cause a lot of grief there.
I just have a question.
Hang on seconds. Yeah, question?
Yes, for case 5. In the case they
Yes.
say that David worked full-time in the business in the year from the year 2017 to 2019. So why is that not classified?
Oh, yes, okay. I see what you're saying here. So it says after graduating from high school, David worked full-time in the business during the years 17 through 19. So that would be 17, 18, and 19. It says, however, in January 2020, he went off to university. So, and I hopefully I didn't confuse anybody, because I think I misspoke a little bit when we were looking at that slide. So just to be real clear, so it says that let me just make sure I got this right here. So he worked full-time during 17, 18, and 19, but not at all during 20. So he's not been involved in the bit. I think the wording of this answer might be a little bit throwing people off. It says, in addition, he has not been involved in the business in any of the 5 years prior to 2020. That's not exactly the way they worded that solution.
I think he involved.
Yeah, that's a little off the way they worded that. But let me go back to how the actual rules are kind of worded here. So the way this is worded is that the active engagement must be in the current year. So if you're doing it in the current year, no problem. You were actively engaged in 2020, you got paid in 2020, no problem. But it gives you a little bit more window. So the current year, or in at least 5 prior taxation years. So to be really clear, because I don't think I was clear about this before. So it's in at least 5 prior years. Those years do not have to be in any particular window. They don't have to be consecutive. So it just is in 5 other years. So in this case, the way I read the question, he's only in 3 prior years. He doesn't have enough prior years into this. I think the way that the solution set here is worded is a little bit confusing, probably. Yeah, the way they word it says he's not been involved in the business in any 5 years. That's not exactly true. He has been in 3. What it should have just said is he hasn't been involved in the business in enough years, meaning he hasn't been in 5. So the exact way to look at this is, if it's the current year, that's enough. If it's not the current year, then it has to be at least 5 in total prior years. Those years don't have to be current, like it doesn't have to be the last 5 years, and they don't have to be consecutive. It could be every other year over the last 10 years or something. So, but it needs to be a total of 5 years. So 5 years of active engagement in the business, think of it as like an investment. You put in 5 years of your life working in this business, you can receive the dividends from that in the future. You've helped build the business, or you think of it from that perspective. Or, and this is an or, not an and, it's an or, doing that in the current year. You've helped the current year's income. That clarifies?
Yeah.
Yeah, sorry. So I think the answer here and the solution is a little like just here, just delete. Let's do this. Just delete this. Just delete that word there. So he's not been involved in 5 years prior to 2020. It could be any 5 years, but it needs to be a total. Needs to be a total of 5 years. Oops, still putting little X's. Let's see, was there anything else that I didn't mention about that? I think that's about it. So like, keep in mind, make sure that you're paying attention to the ages, remembering those couple of little exceptions there about, kind of 65 and over, stuff about divorce. Other than that, you're looking at involvement and age and investment in. Some of that is gray area. If you're doing a short answer question like this one where there's a gray area, just kind of lay it out. You can say, this is gray, this is what they'll need to prove. So short answers, just like this, a couple paragraphs to support your analysis of the situation. And if you're asked to calculate what the tax would be, you can do that like a basic small calculation as well. That's about it for that topic. So there's samples in the text there. There's some examples as well. It might be the same one we had on the slide there for calculating what your TOC tax would be. There's an example of that on the bottom of page 533. You guys want to have a look at that. So again, basically the impact of this, if you got this person with, their income's only 23,000, that's why the income was coming to them. They're going to have to deduct it and then pay a separate tax, which is even higher. And they're going to go looking for that money from the person who was sending it to them to try to do some fancy work there, right? So it's going to put them from potentially, say, a 15% rate up to a 33. I think there's a little bit more. A little bit of stuff about the rates and stuff on 535, going from 15 to 33%. So it's very punitive treatment. So this is a newer topic just in the last couple of years. A lot of people have been working on how to try to figure out, how they're, we did a lot of work with our clients on, how are you gonna, we did pretty well with our clients on this because we were able to find ways that they still fit within these rules. We didn't have to do a significant amount of changes to people. There was some, but with a lot of people, we were able to assure them that they were safe, and here's how. But we still had to do that work to make sure. We had to, so, you can have a rule changes and you got to go back and now you got to reevaluate all of your tax planning you've been providing to your clients, or you have to make sure that the tax plan you have set up is still good. So really a tax plan is something you should be reviewing every year for your clients. And this would be something that's a significant change that if we didn't, keep up to date on these topics and we didn't look at this for all of our clients in their tax planning, and we just left somebody doing something that was no longer acceptable, we could end up with some serious effects of that with their income. Grayson's question, yes, the answer is yes. So if the rate of return is the same as the prescribed rate, I think in that one it was 2%. If they were both 2%, you're fine because you're covering it all under that. Where the danger there is that the additional 3 would fall under the TOC rules. So that's where you'd end up with that one. I see that it's already 8:16. So why don't we do this? I think that pretty much covered everything. I know there's like 76 slides. There's some stuff there on charitable donations and foreign tax credits and alternative minimum tax. Don't worry about any of that stuff for now. The key parts for chapter 12 that we're looking at, let's flip over to here. The key factors for chapter 11 that you're going to be responsible for is able losses, applying all those different losses, the carryovers and stuff, lifetime capital gains exemption calculations, how those two things work together, and scenarios like this with TOSI and the little basic calculations of what the tax would actually be. That's the main crux of what I want you guys to have under control for chapter 11. So what we'll do next class on Monday, we will basically go through, hopefully we'll get through all of chapter 12. And chapter 12, again, I would call this like the sister chapter to chapter 4. Chapter 4 gives you the nuts and bolts of how to calculate personal tax payable. Chapter 12 is going to give us the nuts and bolts on how to calculate your corporate tax. So if we look at the topics here for chapter 12. So before next class, give a read to chapter 12. We're going to go right through how you would compute your taxable income. Now we're shifting completely over to a corporation. So how do we calculate taxable income for a corporation? How do we calculate their tax payable? There's a big section on the small business deduction. How do we calculate? There's a bunch of components in calculating corporate tax payable. It's a different approach than, like, we don't have a bunch of tax brackets. We kind of just have like two. You have either your big business or your small business, and we're going to calculate out your rates. There's also some stuff in there for manufacturing and processing to consider, because again, there's benefits in there for businesses that are job creators. So there's some stuff there too. But generally speaking, kind of conceptually, you could say you got big business, you got small business, and we have to look at that and figure that out. So we're going to get, if you like, back to the number crunching stuff. We're going to be doing some number crunching there for chapter 12, some nuts and bolts. How do we calculate tax payable for a corporation? So have a read of chapter 12 before next class, and we will go through that, do some sample questions, and try to knock out all of chapter 12 next class. If we need a little more time in the next one, we can take that too. Chapter 13 just kind of adds some extra wrinkles to 12. So we won't spend as much time on 13. So if we need a little extra time, we can carry it over as well. All right, so that's it for tonight. If you guys have any questions at all, let me know. I am available. Just shoot me an email and we'll sort you out. In the meantime, you guys, now you have everything for chapter 11. You can get started on your assignment if you haven't already, and we'll be good to go. Have a great night, guys.